Hello, and welcome to the January Market Update. My name is Brad McMillan. I'm Commonwealth's Chief Investment Officer. 2015 was not a good year. In fact, it was the worst year for the financial markets since the financial crisis. That's a pretty big statement. That said, it still wasn't terrible, but the question we have to ask ourselves, given that it was the worst year since the crisis, is what does this mean for us as investors, as citizens, and what should we do about it? And I think the first thing we need to look at here, and I think the most interesting thing about 2015, is the disconnect between the real economy in the U.S. and the financial markets. Let's take a look at the real economy. We've seen 3 years in a row where on average we've created more than 200,000 jobs every month. That's unprecedented. We're back to a new all-time high in the number of jobs. We're breaking new ground on lows in the number of people who are looking for jobs compared to the jobs that are out there. The U.S. economy, in many respects, is incredibly healthy. We're not growing as quickly as perhaps we would like to, but that's not altogether a bad thing either, because slower growth tends to be sustainable, and a long, slow, steady recovery has enabled us to get back to normal. The question is, though, why are the financial markets not reacting to this? I would say there are two reasons. First of all, the recovery is not getting the credit it deserves because it is so slow and steady. Again, I would say that's a positive factor, but nonetheless, the financial market looks at this and continues to worry. The other thing, and this is interesting, is that the factors that have made the economy so sustainable have actually been negatives for the financial markets. What do I mean by that? Let's consider low oil prices. Low oil prices help the consumer. They've helped bring auto sales back to new records, but they hurt the energy companies. They hurt the markets. On the whole, I would much rather have the consumers be happy, but something that's good for the economy is not as good for the companies. Second of all, the strong dollar, which has been the other major negative factor for the financial markets. What does that mean? Well, it means consumers can buy things more cheaply. It means that imports are cheaper. But it also means that companies that export aren't doing as well. And you can actually see this directly. If you look at the manufacturing sector of the economy, it's in a recession, which is a bad thing. But it's only about 1/8 of the economy. The service sector, which is the other 7/8, is doing quite well. So again, you have this disconnect, and what it means is the U.S. economy is continuing to do just fine, and in fact may well accelerate in 2016, even as the financial markets struggle. What do we see as we move forward? I think the financial markets are actually going to start to do better as well. I base that on a couple of reasons. First of all, oil prices are starting to moderate. Yes, they're declining, but they're declining by less. And that's something that will continue to help the real economy, and companies can now adjust to the smaller decline. Second of all, the strong dollar is also starting to moderate. Historically, the dollar has actually declined after the Fed starts raising rates. So we've got two headwinds for the markets that may be going away. On the whole, there are risks out there. Certainly, there's ISIS, there's the refugee crisis, there's China, but we've always had risks. And the fundamentals here at home are solid, and I expect them to continue to improve throughout the year. With that, I wish you a Happy New Year, and I will talk to you next month.